Good morning and welcome to the Monday Call, brought to you by NZ Funds. I'm Stefan Clark, Chief Client Officer at the firm. Banks and financial institutions are essential for driving economic growth. Without the right policy settings in place, economies slow. After a challenging period in New Zealand, it's more important than ever to get the settings right. This morning, I'm excited to welcome Phil Doak, partner at Mosaic, to explore the shifting landscape that banks, insurers and fund managers are navigating, along with the key regulatory initiatives that the government has underway. We will discuss the implementation of the new FAP regime and the growing importance of financial advice, the goals of COFI, banking and insurance prudential regulation, the direction taken by the new government, including how KiwiSaver may evolve, and the debate around competition in the banking sector. Mosaic is a consulting firm that specialises in helping financial institutions overcome strategic, regulatory and operational challenges. With over 30 years of experience, Phil brings deep expertise in finance, technology, operations and risk management, offering unique insight into this important sector. And as it happens, Phil is also an alumni of NZ Funds and has made a huge contribution to our firm. So it is doubly a pleasure to have you here, Phil. Welcome. As a start, it would be great if you could talk a little bit about your role today and Mosaic and how you fit in there. Then we'll launch into the meat and potatoes of the conversation.
Well, good. Hey, thanks, Stefan, and it's nice to be supporting this conversation and having a chat and reconnecting on this basis. Yeah. So, I mean, you explained Mosaic pretty well. I mean, we think about our purpose as a firm is to help our financial services firms architect, execute, and govern operational change. So, as a business, we've been running for a number of years, and we work across the banking, funds, wealth, insurance sectors with around 70 odd people. And I guess from our perspective, the people we have in our team have all come from line roles and working in the firms that then that are now our clients. And so I as you know, having spent 15 years with New Zealand funds and distribution roles, and as COO, I moved to Mosaic about 4.5 years ago, and for me, it's been really interesting, working across the sector and seeing the change underway, the response of firms to the various challenges, which I know we're going to touch on. But I guess just going back a little bit before my time at New Zealand Funds, I actually started in agribusiness lending in the middle of the rural debt crisis. So we might touch on the ComCom review and the implications around that and banks more broadly, but I've certainly been around when lending's gone bad, so I'm a little bit sensitive to things like credit risk appetite and risk appetite in general. But having spent time in rural lending, spent a lot of time in institutional corporate banking with a major bank, and I spent 10 years on major banks executive team, so I've sort of seen the inside of those organisations. So it's fun to bring, that 35 years into hopefully add some value and spend time with clients and help them with what are some pretty interesting challenges.
Well, I've no doubt that you add a lot of value, and with that kind of background and experience in a targeted sector, that's you've got a lot to give. So, why is it important? Let's start there. Banking and financial services have seen a huge amount of regulatory change over recent years, and really, it's actually probably before my career, but in the period leading up to the GFC, there was some, and then post-GFC, there was a heck of a lot. And why does it get so much attention, and why is it so important?
Well, I mean, fundamentally, the strength of our finance sector is fundamental to the economy, right? And the ability for businesses to grow, for capital to flow, trust and confidence from a consumer perspective in their banks. It sort of goes to the core. It's a core engine, and I guess the change has been underway for many years. In fact, if you go back a number of years, I think it sort of started, as you noted, post GFC, where we saw what happens when banking goes wrong, and there were outcomes through that crisis that no one ever thought could happen. US commercial paper market basically locking up overnight, for example. How could that ever happen? Well, and we also saw a lot of behaviours through predating that and through it, which people looked at and regulators looked at globally and said, this isn't from a conduct viewpoint the sort of stuff we want to see. So At and around that time, we saw, I was going back through the various pieces of legislation, and I think a lot started with anti-money laundering, I think back in 2009, which of course we all love, but flowing then on to really the pivotal piece of legislation, which is the Financial Markets Conduct Act, which was enacted in 2013. And at the time, that was the biggest change to New Zealand's securities market in 30 years. And it basically replaced the Securities Act, which I think dated back to the 1950s or 60s in terms of the last time that was in place. So we've seen since that FMCA was passed a progressive uplifting of expectations on market participants, and it sort of started, the first time we actually saw a licensing regime in terms of how the market players operate. It started with supervisors who have trustee oversight of managed funds. It moved on to managed investment schemes, and I recall actually writing the NZ Funds MIS application years back, and then obviously it's flowed into a bunch of other licensing pieces, and it's continued to evolve. And I know we'll talk about the FAP licensing regime, which obviously has in more recent times been implemented, and we'll talk about COFI as well in terms of the next phase of that. So I guess in terms of why is it all happening, the reality is as an economy, if we're not, other jurisdictions have also been moving, and we'll touch on this, whether it be the US, Europe, UK, Australia. They've all had their challenges, and in more recent years, we've seen particularly a range of conduct-related challenges, the most recent being sort of tabled by our colleagues in Australia with the Haines Royal Commission. So I guess the upshot is New Zealand needs to be seen as a safe, attractive market to trade with, and from a New Zealand Inc. perspective, it needs to be supported by legislation that's going to actually enable good outcomes in terms of financial resilience and growth.
And there's a bit of a trade-off, right? Because you want to have, on the one hand, regulation that enables innovation, and then on the other hand, you want regulation that protects consumers and encourages capital investment, which reduces, if you're deploying capital, you want to, risk is really important to you. And so that is something that, particularly for a trading partner or an investor locally, will be top of mind. And I guess throughout this whole conversation, that'll be coming through, and parts of it is we're trading off different goals. On the one hand, risk-taking, and on the other hand, protecting clients or consumers from the outcomes of adverse risk events. Okay, you mentioned the FMCA and underneath it and what we've called the FAP regime. Can you take us through what that is, and particularly the FAP regime, and why it is so important and where we are at in the journey?
Sure. So the financial advice providers, the latest incarnation of financial advisor legislation, it came into full effect in March 2023, and that prior to that date there was regulation, right? But it was centred on individuals. We had the concept of authorised financial advisors and registered financial advisors, and as an authorised financial advisor, you had obligations around how you your level of qualifications and skill sets, and you operated under a code of conduct and all those really positive things. But the focus was on the individual. What the new regime transitioned to was a focus on the entity, the business, the owner, the entity that's providing advice, and that advice can be delivered by, in the new regime, financial advisors who again have appropriate levels of qualifications and operate to a code, and also the concept of nominated reps who aren't necessarily needing the same levels of qualifications but are operating within an organisation that's put in place a very robust set of training and or systems to ensure the outcomes of the advice they're providing are as close as good as those that might otherwise be provided by a financial advisor. So the focus, we've created these designations, but they operate within a FAP, or financial advice provider. That is the licensed entity. And the interesting thing around that is that it's in those that have all, and I'm sure many on the call have gone through that licensing process, the requirement to think about you as a business entity. How do you operate? Who do you outsource things to? What's your governance? What's your oversight? How do you ensure advice quality is at the level that it needs to be? So So we've seen this shift to from an individual to an entity. And I guess the whole backdrop of this is to continue to build on and build confidence in the sector. And from a consumer perspective, that it is a profession, and it brings it into the same sort of construct as other licensed entities. And I guess we've seen different parts of the sector transition. I think for firms that were operating in the funds side as AFAs, the transition has probably in many ways been a little easier. But if you move into the insurance sector, who tended to operate more in what was the RFA or Registered Financial Advisor environment, there's probably been more significant change required there. And, everyone from an insurance perspective, insurance advisors is absolutely focused on doing the right thing for their clients as well. But the challenge, I think, has lied in trying to bring more formality to advice, and advice as a process, and meet the expectations around what that looks like. So there's been a lot of work required by the sector, and that particularly in those parts to get ready and get out there to and transition to meet those new expectations.
So practically, licenses were granted by the FMA, and the thousands of advisors across the country or advice firms would need to seek a license, right? So there's a lot of work involved in that for a lot of work for everyone. How has the sector gone, and what has the FMA signalled about its happiness with the outcome, or has it taken a different perspective and is a bit sort of dim on some elements?
No, I think the FMA, they've published in more recent times their first review of where the sector's at, and the FMA go out and visit advisory firms and sit down with advisors and say, we've read your license application, show us what you do, don't just tell us what you do, show us and evidence that. And I think the reporting from the FMA was tonally positive in terms of how the sector's transitioned. A number of things, though, they called out, which, again, I think reflect just where certain parts of the sector are at, and that's being able to evidence that you've really operationalised advice within your business. Record keeping came up as a key one, and it's the old adage: if it's not written down, it didn't happen. And certainly the FMA's focus is on the show me, don't just tell me. So I think as advisory businesses have progressed, addressing how they can truly evidence what they do was an area of focus. And the other area I think that came through was around oversight. Who's overseeing advice within your business? What's your governance look like? And how do you ensure that, having done all the work to implement and design a really great process for your clients, it's actually happening, and you can demonstrate that. So they were a number of the areas that the FMA sort of called out, and they were focused on advisory businesses that weren't operating with what, as I mentioned, nominated reps. I think they're moving now to, having published their initial reviews, now looking to expand that to those that are operating with nominated representatives, which has a different set of challenges in that the focus on the systems and the training to support individuals providing advice in that context, the expectations are high in terms of how that's operationalised. So we'll see how things go, but I think, Stefan, it's been the industry should feel good about the transition it's made.
Fantastic. Financial advice, New Zealand is famously under-advised compared with comparable other countries. And with KiwiSaver and, I guess, the baby boomer shift into retirement more and more, there's a growing demand for advice. Can you talk us through how you think that is being viewed by the government and by the FMA, and how that plays into the regulatory framework?
Yeah, I think, it's interesting. Notwithstanding, I think where we're at as an industry, particularly around KiwiSaver, we've achieved a lot, with circa 110, 115 billion. I like to look across at what's happening in Australia, who are sitting with 3.5 trillion of assets in the superannuation scheme. And almost in some ways you look across and with a degree of envy at the size of what they've got. And then in other ways, there are certain aspects of how that industry is structured that I'm quite glad we don't have some of those problems. And I'm hopeful we don't create them. But to your point around advice, when we'll touch on KiwiSaver, probably possibly a little bit later, there's naturally a big focus on accumulation and contribution levels, and rightly having New Zealanders achieve growing level of capital where they can enjoy a dignified retirement. But from an advice perspective, my view is that the conversation at some point, and this is shifting in the Australian context now, is one of having worked so hard to build that capital up. Making the wrong decisions in decumulation or in retirement can be devastating, right? And so I think that's where the role of advice, particularly around KiwiSaver, is going to become even more important as members achieve and move through retirement, move to the I've earned this, I've accumulated this capital. How do I make sure that when markets go down 20%, I don't make decisions that are going to be costly in terms of my ability to enjoy that dignified retirement moving forward? So I think there's the challenge around that, though, is not everyone's coming out with KiwiSaver with large balances, and I think certainly the Australian industry's challenge with this, and I think we will be as well, is how to deliver true financial planning, meaningful advice to support decumulation for people that might not have the same size of balance but do it at scale. Right, and I think that's an opportunity and a challenge for the sector. And I think in terms of insurance provision, that's going hand in hand along with supporting clients on their journey. There, from an insurance perspective, there's a trajectory in terms of the contribution life cover makes relative to mortgages and the likes, and thinking about from a broader risk viewpoint, how am I managing those non-financial parts of my risk profile as a person. And as you noted, underinsurance is a challenge, and we've seen the weather events that have played out in the last period, which have been devastating. And but it's also insurance sometimes isn't necessarily cheap. So how do you make that affordable? How do we educate people to see the real value in that as an opportunity for the sector as well?
Yeah, and it's not just hard advice. Actually, it's funny, I was reading one of the reports from, I think, Russell today about the value of advice. I don't know if you saw it come through. And the thing that really stood out to me is they emphasised strongly the importance of the behavioural piece. It's not just, is it a good product that's fit for purpose and suitable? It's, will you be able to work with this, with the solution for a long time, and be able to, with the ups and downs, as you mentioned, be able to stay the course, for example. And only then do you really get the benefit of it. So,
absolutely. And to me, that's about a people touch. That's about an emotional engagement, and that to me, from an advice perspective, is the humanistic connection advisors have with clients through those difficult periods, and to be able to hold the course, whether it may be, or manage the emotions that sit around health, trauma, or whatever. I think is the essence of that.
Computers aren't quite there yet. Might take a few more, a little bit longer before we get there. Okay, hey, before we move on from the FAP regime, because there's no shortage of good stuff to talk about, what's the next phase for this for advisors and consumers?
You mean in relative to the advice side of things?
Yeah. Have we finished with the FAP piece, or is there another lift?
Well, no, I in terms of anyone dreaming up any new regulations, if there are, I'm not sure where they are because I haven't seen them. To me, I think it's bedding in, right? And just from a regulatory viewpoint, there is one angle, and it's not just related to FAP. It's broader than that. But it's manifest in a couple of the standard conditions for a FAP license, and that's around cybersecurity, technology, and business continuity planning. I'd call that operational resilience, right? And so I think there will be an increased focus from a regulatory viewpoint in time on really getting clear on businesses really understanding operational resilience more broadly and how robust those their foundations are to respond to things, whether it be climatic events or just maintain the resilience of your business in the face of a major disruption. And we saw that in recent times with CrowdStrike. Someone cutting a bit of code, releasing it, and it seems like half the Western economy gets taken down. How do you respond to that? And if I look at anywhere where, from a regulatory viewpoint, in New Zealand context, we're still in a bit of a catch-up mode, I think it's that, because operational resilience in other markets has really come up the radar, really come up in terms of the priority for regulators. Certainly is in the European Union, around digital and cyber resilience, in the UK, in the US, and in Australia. There is a piece of regulation underway there, which is requiring certain deposit takers and funds management firms to really uplift how they think about operational resilience certainly beyond where we are now at the moment. So I think I don't see necessarily a new waves of regs per se. I think, and we might touch on it later, I think we're going to see under the new government a simplification of licensing. As you can work at the moment, if you're a bank, you can probably have 4 or 5 different licenses. And over time, I think it's recognised that's probably not particularly efficient or effective. And so moving to a single market license, which may, and we don't know what that's going to look like yet, but it may well have, a schedule if they'll have particular conditions that reflect if you're a financial advisor, particular conditions that reflect you if you're a licensed fund manager. Certainly the direction is trying to simplify the licensing regime in the broadest context, not make it more complex. But I think from a regulatory viewpoint, the focus is going to be on bedding that advice in, and the FMA is very focused on outcomes. So, what are the outcomes that that this regulation is generating? Are they good outcomes? Are they what people that they align with FMA expectations? And if not, why not? So,
correct. Okay. Another major piece, and we touched on it a few seconds ago, was just COFI, and that centres around conduct within financial institutions. Can you take us through where it came from, what its genesis was? And, I understand it's been a bit of a soccer ball politically. Where are we now, and how's it going?
Sure. Yeah. So if you look across the various international jurisdictions and where licensing and regs play out, we New Zealand, and this is and to be clear, COFI relates to banks and insurers, right? And there was a gap in terms of how conduct was regulated. Other jurisdictions have got quite explicit conduct regulations, and by conduct we're referring to fundamentally is an organisation delivering fair outcomes to its customers. In the UK, there were a number of conduct-related issues that led to the UK and the FCA responding. In Australia, you had the Haynes Royal Commission, which basically dragged everyone in front of that commission and unpacked a whole bunch of activities and practices that just weren't good in terms of delivering good outcomes. And so, from a New Zealand perspective, whilst we have the Financial Markets Conduct Act, and conduct being an operative term in that Act's name, the banks and insurers were largely regulated by the Reserve Bank for prudential purposes, and we'll touch on prudential purposes. But fundamentally, their focus is on ensuring banks and insurers are strong financially. They can meet their obligations, they can meet claims, all those sort of things. But there was nothing that really was overtly focused on ensuring that they operate on a conduct basis. So basically, COFI, or Conduct of Financial Institutions Act, was designed to protect consumers and their dealings with those organisations by putting the consumer at the forefront of those institutions' decisions and actions. And the whole theme of that is to treat clients fairly. So banks and insurers are now going to be licensed for conduct, which is new. I think, obviously, from financial advice provider licensing, MERS manager licensing, I think the FMA, because they were licensed already generated under the FMCA, the FMA probably felt there was enough leverage for them to be able to exert influence on customer outcomes and conduct outcomes, leveraging that. And of course, as you know, as a fund manager, you've got a fiduciary responsibility to do the right things and act on behalf of your investors. So there were some of those pieces were there, but there was a gap, and so they've closed it.
Okay, and I guess fairness of itself is a difficult term, so I presume it's very, very well set out and explained under the regime. How has the regulation, the licensing process gone, and how far through it in the journey? And is it going to translate to visible outcomes for consumers, or is it more something that within the organisations is how they make their decisions and the production of products and services and the way they give advice and so forth?
Yeah, well, hopefully it's going to be both. It would certainly it's changing and influencing how organisations internally are responding. From a licensing viewpoint, the licensing is required, comes into effect March next year. So between now and then, those institutions are going through a licensing process. As part of the licensing process, the core of it is those organisations having what's called a fair conduct program, and that program covers and has to document how do they ensure that they're giving fair treatment to consumers and what are the practices. And that goes to everything from how they manage products and services through the life cycle. Are they designing them with the end customers' needs? Are those needs changing? Are the customers they think that are using those products actually using those products, or is some other group suddenly using them? Are their communications affected? Are the disclosures adequate? How are they working? Where they work with third-party intermediaries? How are those relationships supporting good customer outcomes? So it's been a huge exercise within these organisations. In fact, our firm's been involved in supporting a number of them to review policies and practices and help them develop those fair conduct programs. Fundamentally though, and the FMA has been very strongly of this view, this cannot just be a tick box compliance exercise. And so it's one thing to write all this stuff down. It's another to have it as part of your culture fundamentally. And it goes to how decisions are made around things to do, things not to do, whether it's choosing to invest in technology at certain periods of time, those dynamics all need to play out. So I guess it's certainly driven a lot of activity within large organisations, or not just larger, all the organisations that are involved in this. They are now in the process of submitting licensing applications. I understand there's around 8 or 9 that have already been granted, but all those organisations are going to need to have those licences done, and they'll be submitting them at the back end of this year, because come March, if you're not licensed for this, you're not in business. So, I think certainly the FMA expectation is that those fair conduct programs are not aspirational documents. They are happening, and they are real, and they are live. And so I think to your point about what's it all going to do, what's certainly had impacts internally within these organisations, time will tell. And I think that's where the FMA, I loop back to this sort of focus on outcomes. And the FMA has been very active in recent times around enforcement. And particularly where product outcomes have not been commensurate with what the intent was, and there's been some well-publicised fines in that area. Time will tell, I guess, Stefan, in terms of how this translates ultimately to consumers, outcomes they receive over time. But it's setting a reference point now and requiring a level of practice review documentation to make sure that they can deliver fair outcomes. And it's interesting, the concept of fair, I think that's going to be explored more and tested probably over time. The FMA recently conducted some research, consumer research, with a bunch of scenarios, which were asking people, did they think X was fair or Y was fair, which was quite interesting. So I think we're going to have that conversation. The conversation is going to continue.
Yeah. I guess as values get loaded in it at some level,
yep.
And then but at the same time, as you say, it's a reference and a starting point, and a very important thing that we as a society sort of come to agree on, and then work from there. Okay, prudential regulation. Well, you mentioned that too. What is prudential regulation? Let's start there, and why is it changing, and for whom, and why is it so important?
Yeah, sure. So, prudential regulation is largely owned by the Reserve Bank, and it's focused on really the financial soundness and substance of banks and insurers. and also non-bank deposit takers who perform a very important role in the economy. So it goes to basically these organisations' ability to withstand financial shocks, whether that be as a bank, credit outcomes which are not what we wanted, or other issues that might require the Reserve Bank to have to step in and protect the customers and deposit takers of those entities. So typically, the sort of regulations that cover, they can be quite technical. There's a bunch of standards that speak to how much capital banks should carry and how to calculate their capital. It talks about the liquidity of their funding and the terms of that liquidity and the extent to which that funding, the funding sources align with where banks may be in fact lending. It talks from an insurance perspective around their ability to meet claims and their solvency. So it's really those sort of things. It's not really about behaviours per se, more around those matters that sort of go to the operational and financial robustness and soundness of those organisations.
Well, everyone would want their organisations to be robust and sound. What are the trade-offs? So there's some perverse outcomes or consequences that aren't perverse that you can sort of foresee, and why is it so important that we get it right?
Well, it's an interesting point, particularly at the moment in the context of the sort of the Commerce Commission's banking review. There's a lot of discussion around the level of capital that banks should have, and the Reserve Bank over the last few years has been reviewing that. But it doesn't. The Reserve Bank of New Zealand is operating and developing its views based on what it perceives as systemic risk in the sector and the frequency by which that systemic risk could manifest itself, i.e. in terms of bad outcomes and organisations facing financial stress. We don't operate, though, although we're an island, we don't operate as an island. There are global standards around capital, and those global standards we also need to, we are connected to and are subject and are subject to. But where it gets into an interesting discussion is around risk appetite and, how much capital. I mean, capital, there was a level of capital when I started the industry where the expectation was circa 4.5-5% of your balance sheet was held as pure equity, and that same number is now closer to 15%. So that requires you can look at that and go, well, that's awesome from one perspective in terms of the ability of any organisation to withstand a major loss, whether it be an operational risk issue or a credit risk issue or something else. But the question then is there's a cost associated with that, and how much is too much? And are we too conservative? Are we trying to protect the economy from a level of risk which is the probabilities of which don't seem realistic? And I think it's an interesting debate, Stefan. There's been plenty on it. I think it will continue. Particularly also how that level of capital and those requirements flow through to smaller, not so much the major banks, but smaller organisations, and how much capital is a home loan, how much riskier is a home loan versus lending to a small business. All those sort of things are the subject of some debate at the moment. I guess my only observation would be, having been in the sector for 35 years and gone through the GFC, having seen when it goes wrong, it's easy to make risk to take a view that we maybe are conservative, but when you see when it goes wrong, you then question, well, maybe how much risk appetite do you really want? And I think it also goes to just our ability as a country to attract capital into our markets as well. If the financial services industry is seen as robust, well capitalised, profitable, all those sort of things are more likely to attract capital flow. So I think there's a debate now.
It's going to be a never-ending debate at one level, I imagine, lots of things in these sorts of economic spaces. Okay, KiwiSaver is growing in its importance in New Zealand and the New Zealand economy and capital markets generally, and also as a focus from the government because of, it's 115 billion currently under management within the give or take, which is a huge pot of cash, and it is evolving. Every time a new government steps in, sometimes they tinker with it at the edges. Other times there's been some slightly bigger changes. Where do you think it's evolving to? And what has the minister signalled about his intentions in this space?
Yeah. Well, I think we've sort of touched on a couple of the elements of it, I guess, Stefan, in terms of just the shift on trying to increase, get our contribution levels to a level. I mean, I was at the FSC, Financial Services Council conference, a couple of weeks ago, where there's no doubt it's a conversation at industry level about what is next. I think there's a recognition to maintain confidence in it. People don't like the rules being changed, obviously, and so there's a balance between what we define as tinkering, I guess, but in terms of a focus on increasing contributions or people being able to sustain contributions through periods when it's harder to do so, particularly in the face of cost of living pressures, an important bit. I think member engagement generally remains a challenge, which goes right back to financial literacy and this conversation around that. My personal view is I think we need to see a lot more of financial literacy at the schooling level, so people actually can start to grasp the concepts of compound interest and what it can do in that sense. So I think there's certainly going to be a review in the industry conversation in that regard. I think from a political perspective, we've prior to the election, National signalled sort of sentiments around the idea of having KiwiSaver schemes more significantly contribute to infrastructure in New Zealand, and I guess the potential role of private market assets or unlisted assets in KiwiSaver schemes. And it also was signalling at the time, the prospect of, maybe New Zealanders would benefit by having money in more than one KiwiSaver scheme, because they might get some greater levels of diversification. I think as it relates to the second one, I think that's been sort of tuned back a little bit now. I think those in the market will know you can actually do that now. You can get exposure to not so much different KiwiSaver schemes, but certainly a whole range of different managers and asset classes through existing KiwiSaver schemes that are out there. So I think I'm of the view that I don't think heaps and heaps of choice, I don't think is necessarily a good thing, because it's hard enough for people to understand what they've got now and where they've got in a KiwiSaver context without adding another scheme, multiple schemes into the mix as well. And I think operationally that would be a challenge. But I think the more interesting conversation is around private market assets. It's interesting as a KiwiSaver manager, you have fiduciary obligation to your clients and what their needs are. It's not in and of itself to New Zealand Inc. Having said that, in theory, there is an opportunity there will, for KiwiSaver funds to find a role for an allocation to those sort of assets within their portfolios. But there's also some key challenges in doing that, relating to the fundamental design of KiwiSaver, which actually requires liquidity. And again, I like to look across again at our Australian colleagues who have a significant, I think, circa 20% or so in their circa $3.5 trillion of superannuation assets invested in what you call unlisted or private market securities. And they have their own challenges around price transparency, liquidity, and all those sort of things that they're trying to manage. And interestingly, when we talk private market assets, the universe of that, what that can contain, is actually very, very wide. And the Australian market, interestingly, quite a substantial part of those investments are in fact in offshore vehicles. So I think there is a role to play. I think the conversation might be better placed on what, from a New Zealand capital markets and from a government perspective, what we can do to create the entities into which a KiwiSaver manager can invest, whether they be infrastructure related or others. If we can create the vehicles there that can deal with some of those matters around liquidity, price transparency, all those sort of things, then I'm sure that'll be potentially an area of excitement for managers to take those positions. And obviously some New Zealand managers are already and good on them from that perspective. I think it's going to be a conversation that will continue. So I know that sort of links into the sort of capital markets more broadly, and I know the minister's sort of got that earmarked for the later this year and flowing into next year to have wider conversations on. So I think they're sort of some of the elements, Stefan, I think that are going to be in the mix.
Okay, just to try and paraphrase, because as a KiwiSaver manager, you need to be able to facilitate redemptions and withdrawals from your scheme, which makes for your members, and so that makes making sure you can actually sell the asset that you've invested in very, very important. Which comes to that liquidity, and also be able to price the asset that you are invested in. Very, very important. Now, if you go, what I think you're saying is if you go and buy the asset, so you go and buy a piece of infrastructure or invest in a piece of infrastructure directly, it's very hard to do that. We don't price dams, for example, every day. And it's hard to sell a portion of a dam, for example. Whereas if you go and buy an infrastructure company that's listed on stock exchange, for example, say Meridian, which has a bunch of dams and other assets, then you can sell a portion of it and invest in these types of assets. So that's really what I think New Zealand. My perspective, at least, is that using this pot of capital, investing in areas where there's good returns for investors and supports that our community is a great opportunity, but you've got to balance it off against the other factors that need to be taken into account. And,
we've just got to find a way to make it work.
We've got to find a way, yeah. And it's great that there is now. I mean, we're a long way away from where Australia is, of course, but in terms of building the superannuation market and the journey that we're on there with KiwiSaver. But if it has worked for Australia, that's something that's useful for us as a reference.
Yeah, and we can learn from their challenges as well, and which I think will be helpful.
Okay, so the Commerce Commission recently released a report on the banking sector competition in New Zealand, and I understand you're in the process of writing an article which is going to be published soon on this particular topic. Take us through your perspectives on the report. What does the report say, for starters? And what are your observations about that report?
Yeah, okay. Well, there's been plenty of commentary about it. I guess, I guess the first thing I'd note was its scope was on personal lending and deposits, right? So, which is fine, but obviously there's more than lending and personal deposits that drive bank profitability outcomes. And I guess when I was reading it, I think it's provided a useful, a very useful and valuable assessment of the market in terms of those of personal lending and deposits. And and the reality is we have an oligopolistic sort of structure. This industry isn't the only industry in New Zealand, of course, that has that sort of dynamic to it. And I think Minister Willis used an interesting analogy. I think she described the level of competition as a friendly pillow fight, which was sort of quite. I was trying to imagine my days fighting with my sister with pillows, but I guess that's probably a characteristic. I mean, look, I think roughly circa sort of 14 recommendations. I think at the margin, they could make it, I guess, an incremental positive impact, some of them. But I think there's a lot of talk. I mean, I found I was a little trying to get clear on what the really unpack. And it's wearing my consultant hat. I guess what the problem is we're trying to solve with here, and because depending on what you read, it can be. Banks make too much money, whatever too much means. Actually, no, it's just Aussie banks that make too much money. By the way, they're Aussie banks, so all the money goes back to Australia. We're underserving certain segments. We're serving segments with not enough. The quality of the services is behind where it could be. There's a whole list of sort of stuff in there, right? And so, to varying degrees, certain of the recommendations I make a modest impact. I guess the big thing coming out of this is this sort of conversation about disruption, right? And I'm sort of interested in how that might play out, and what would you have to have? What would the prerequisites be for an entity to actually be a disruptor, right? And so there's a number of things around. Well, is it because they've got less capital? They've got a cost of capital that's less than anyone else. Have they got a cost of funds that's less than anyone else? Have they got an operating model that's much more low cost and less than everyone else? And you might have all those things, but the biggest thing is going to be, have they got a consumer proposition that is sufficiently attractive that people will move and change their behaviour? And banking's sort of a little bit like going to the dentist. You deal with it when you have to, and noting there are certain moments when it's obviously really high impact in your life. So I look at that and go, you've got to bring those things together, and you need to have the human capital in an organisation to come up with that innovative solution. But they've got to scale it. They've got to be able to scale it to a level of commercial viability because someone has given them the capital to execute. And then I guess, sitting across that is, we're, as a country, we're the population the size of Sydney, right? So it's how do those things come together, and whether capitalising Kiwibank will do that, I'm not sure. Whoever's going to provide the capital, Kiwibank, going to have some risk reward, aspirations. I don't know how different they're going to be from an existing shareholder in an Aussie bank, which, by the way, is probably members of KiwiSaver schemes as well, who have their own returns. But I guess hopefully, though, however it plays out, disruption in the context of providing new services to New Zealand consumers is a positive thing. Disruption in organisations recalibrating risk and credit appetites and operational risk appetites inappropriately, I don't think is a good thing, because at some point chickens come home to rest, and in the past they have, and ironically they have with New Zealand government-owned entities. if you go back in history, so. I think there's still plenty of conversation to run. I mean, to me, the more interesting piece that's now happening is this finance expenditure, this select committee review of rural lending and sort of business lending, business services, because that's fundamentally about capital access for the productive economy, right? So from a broader New Zealand Inc. perspective, how can we, what are we doing to ensure cost-effective capital is available to our businesses and our SMEs to be able to scale, and to the degree that there are impediments to that, unpacking those, I think, will be an interesting conversation to have. And so it'll be interesting to see really how that part of the process, which was obviously completely separate to the work the Commerce Commission did, will play out. But there's still back and forth going to go on. I think there's a natural tension probably between the Commerce Commission and the Reserve Bank, one wanting to sort of release some regulatory pressures to support the potential for innovation. The others, rightly wanting to make sure we don't blow ourselves up in the process. So, at some point.
Yeah, I guess there's a lot in there, and if you believe that the banks are, making excess profits, then it's, hopefully it's not too hard for someone to come in and compete away some of that, and but it doesn't seem to be happening. The banks just hold market share and share it between themselves, and whether or not you believe it's excess. So obviously they're delivering something of value to the community. So
yeah. And look, it's there's the social license and holding to account is really important. And I mean, it sort of loops back a little bit to the Kofi conversation we had, Stefan, around conduct, right? And there is tension, and there should be tension. And I'm sure there will be. I mean, look, bank profits has been a topic of discussion for 35 years I've been in the sector, right? But, Aussie banks have been here since 1840 or 1860 or so. So, barring major credit blow-ups, they're probably around for a while yet. And they'll respond. And if they respond in a way to a new competitor that is for the good of New Zealand consumers, well, that's a positive thing, right? So.
Absolutely. Okay, you mentioned just that innovation piece. I guess the last thing I wanted to touch on with you is emerging trends in the direction of where we think, because technology is advancing very quickly, as you know. It is harder for some organisations to embrace that and make the changes within their businesses to use technology, but it's also easier nowadays for new organisations to create new technology and offer something to society. So, which is where most of the innovation seems to be happening in the technology space. Take us through where you think the big themes are and what to look out for.
Yeah, so I think on the technology side, I mean, we talk about this a lot within our firm and our clients. I mean, people are thinking about AI and what does the opportunity set look like? Look like there. For me, data is the lifeblood of financial services in many ways, in terms of supporting client outcomes, supporting decisions, and those sort of things. And And even the ability to leverage AI fundamentally requires you to understand your data, understand where it is, how it's stored, have it accessible, and the quality of it. So everything we sort of see is the role of data, and whether that's supporting data promulgated via open banking into that opportunity set, continuing to work on that side of things from a business viewpoint is a challenge, but therein lies the opportunity, because it fuels so many things, and yet from a maturity perspective, we still have in many ways a long way to go in terms of managing that. So there's a challenge and a huge opportunity in that regard. I think I touched on resilience earlier. I just think as we face into climate change, in particular, but not just that. I mean, CrowdStrike showed the effects when something goes wrong in an interconnected ecosystem of technology and organisations and vendors and suppliers and all those sort of things. How are businesses positioned to ensure they are resilient and they really understand those risks? And it's not just from the business perspective; it's consumer resilience as well. How are we as a nation? Consumer level, have ability to withstand shocks? Because I just think whether it's climate related, geopolitical related, all those things that flow through, and financial markets volatility, all those things flow through to outcomes that impact on real people and organisations. And so I think resilience and deeply understanding that more is going to be a feature of things going forward. And just trying to keep ahead of the tech curve, and trying to keep connected to clients, connected to the people that financial services businesses serve, who at the end of the day are what we're about. So we should be about.
Fantastic. Okay, Phil, thank you so much for your time. It has been really insightful, our conversation, and we've covered quite a lot of different topics, hopefully to a level that was valuable for everyone. Some of them, as you know, can be quite technical, but I think, Phil, you've done a really good job of hitting the core elements to each of them and why they're important. So,
well, thanks, Stefan. It's been good to chat, and I hope it's been worthwhile. Thank you.
Fantastic. Have a great week.
New Zealand Funds Management Limited is the issuer of the NZ Funds Active Income Series, NZ Funds Active Inflation Series and NZ Funds Active Growth Series, together the NZ Funds Active Series, as well as the NZ Funds KiwiSaver Scheme, the NZ Funds Managed Superannuation Service, NZ Funds Wealth Builder and NZ Funds Income Generator. For further information or to request a copy of the product disclosure statement for each of these, please contact NZ Funds or visit nzfunds.co.nz. This recording is provided for information purposes only. The information provided is not intended as a substitute for specific professional advice on investments, financial planning, or any other matter. Past performance is not an indication of future returns.